introduce you this whole thing.
Oh, this is Justin. Sorry, Dustin.
Yep.
And Dustin is part of Enactus.
So a U.S. Treasury is a type of bond, and say I'm the government, right? And you want to buy a U.S. Treasury. So a U.S. Treasury, let's say you want to buy a 10-year U.S. Treasury. The yield on a 10-year U.S. Treasury right now is about 2%. So you give me about $100, right? And I'm the government, and I'm going to pay you $2 every year for 10 years. And at the end of that 10th year, I'm going to give you your $100 back. And that's usually what it is. It's debt from the U.S. government. Bonds and debt are usually synonymous in the financial realm. So if you hear debt, think bonds. But can companies have bonds? Do you guys know? Yeah? You're shaking your head yes? Why do you say yes?
Well, because many raise capital as well. Companies need to raise capital as well. So that instead of just issuing stocks, you can issue bonds and take taking loans.
Yeah, so yeah, companies can have bonds. All the major companies you guys know, Coca-Cola, Johnson & Johnson, they all have debt, right? And a lot of that debt is financed through bonds. So instead of, like, say you didn't want to buy a U.S. Treasury, right? Say you don't like the government, and you want to buy a bond from Coca-Cola.
Love Coca-Cola.
All right, exactly. So instead of buying their stock, you're like, I want to buy their bond. And so what intrigues someone to buy a bond is usually the yield on that bond. So usually yields on bonds for corporate bonds, I mean company bonds, are between like 4 and 5%, which is really good. And when the U.S. government's paying about 2%, and your savings account's paying 0%. So it's just keep that in perspective as where you can put your money and how you can get a bigger return. Who knows what a mutual fund is? Anyone? No? Have you guys heard of that term, mutual fund? Yeah? Okay, so it's the same. Oh, go for it.
I'm sorry, before you go on to mutual bonds, so the actual definition of a bond, or mutual funds, before you go on to mutual funds, the actual definition of a bond is it's like stocks, except for the fact that you have to pay something back.
Okay, so it's not like a stock, as it means you own part of the company. But say, all right, let's keep corporate debt. It's a little bit easier to understand. So I'm Johnson & Johnson, and you don't want to buy the stock, but you want to buy the debt. So you want to buy a bond. So you're entitled to that bond. And essentially what a bond has over a stock is when you're looking at the capital structure of the company, essentially a capital structure is all its assets and all its liabilities and all its equity. If that company were to fail, say Johnson & Johnson fails, it goes bankrupt tomorrow, you would be given that, since a bondholder is higher on the capital structure as opposed to a stockholder, you would be given the payout of that firm when it liquidates. So you'd be first to be paid your entire value of the bond, and plus you would get your yield. But you don't own part of the company, if that makes sense.
So with bonds, you receive yields even when the company is still operating.
Yep.
So the difference is you just get money if it fails.
Exactly. So if the company fails, the bondholder would get paid out first before the stockholder would.
Okay, but stockholders still get paid at.
Yes. Yeah. Stockholders will still get paid if there was money left over in the company.
So that makes sense because if you are an owner of a company, you have a stock, right? So you partly own that company. You're going to pay your creditors, the people you owe money to.
Exactly. The creditors get paid first.
Debt, so you pay them first. So you're paying off your debts before you give the profit to the owners of the company.
Exactly.
And you get paid your yield yearly, and then once your bond term, say 10 years ends, then you get your full back.
Yep, you get your principal back at the end of the term.
That's what I'm getting. So it's not like a dividend, except it's just your yield being paid back yearly.
Yep.
Okay.
Does that all make sense?
And what usually gives you more money, bonds or stocks or bonds?
So yeah, I mean, it's a very complicated answer. So stocks over the past year, the market past 4 to 5 years has had about an annual return of about close to 10% nominally, which is a pretty good return. But there's a way to play with different types of stock or different types of bonds. So there's corporate bonds, there's U.S. Treasury bonds, right? So a 10-year or a 30-year, as I alluded to earlier. And there's TIPS, which are Treasury inflated protected securities. It means they protect you against inflation, and those have a great yield too. Are you guys aware of the relationship between interest rates and prices of bonds? So they're inversely related. So as interest rates drop, prices of bonds go up. So say 20 years ago when interest rates were really high, you bought a bond, right? And that means the price was really low. Now interest rates are extremely, extremely low. So over those 20 years, you would have made a killing in capital gains, because interest rates have dropped so much, making your bond extremely valuable. Today, interest rates are really low. So from my personal perspective, I wouldn't buy a bond because they can't go any lower. Interest rates can only go up. And what happens when interest rates go up? The value of your bond goes down. So you can think of it like that, and that's how I do. So I kind of stay away from the bond market. I have my own reservations, thinking there's a bond market bubble right now. So I'm kind of just watching the market and seeing where it's going to go. So I like stocks right now. Yeah.
But it seems that bonds are way less riskier than stocks. You know what I mean?
That's exactly right. Bonds are extremely safe, especially the U.S. Treasury, right? The U.S. government supposedly will never fail. So you can buy a 10-year and get 2% every year. But through research and through putting your time where you want to invest money and putting your money in safe stocks, you can beat that 2% return easily. It's just you have to put the homework in to get that return. But yes, you are exactly right. Bonds are always safer than stocks.
How do you predict these things? Isn't the market so unpredictable? How would you possibly be able to? I mean, you watch the market now, you see a trend, but tomorrow it could completely change. So how do you know when to jump in and when to get out?
That's a great question. So no one can see the future, right? So all you can do is base the future off what has happened historically. So historically, there have been very similar trends as to what today is, and people predict out all the potential ways the market can go, right? And there's several different ways, but then it all comes down to your opinion, and then you're kind of speculating where the market's going to go. So say Johnson & Johnson just released this really good news about the market, and you're like, oh, I like Johnson & Johnson, I think their stock price is going to go up. So you buy it today, think it's going to go up tomorrow, and it doesn't go up tomorrow. So you're like, oh, well, I thought the news was going to make the stock price go up. Sometimes it does, sometimes it doesn't. There are hundreds of variables as to where the market's going to go. People commit their lives to doing it and still don't know how the market works. I'm sure you guys have heard of the random walk, where the market can go up or down the next day, depending on whatever variables. It's really interesting because there's no finite solution as how the market works. So every day is like a new surprise as to what's going to go up and what's going to go down. That's why it's exciting.
Okay.
If I knew what the market was going to do, I would be a very rich man. Let's try and go a little bit quicker, right? Okay. So who knows what an investment portfolio is? I'll just run through the rest after this.
Oh wait, did we talk about mutual funds?
Oh, sorry, mutual funds. So what's a mutual fund? It's an investment vehicle, right? Let's say I'm a mutual fund. It pools, and you guys are all my people I'm going to take money from. So it pools all of your guys' money together in one fund. I'm the investment manager, and I'm going to invest on your behalf on a set of stocks and bonds and maybe some treasuries and maybe some other asset classes. I'm going to invest on your behalf because you think I can invest better than you can. So I'm going to put all my money, or as an investment manager, I'm going to put all your money in all these different asset classes. But I'm going to charge you to do this, essentially. So I'm going to charge you maybe 0.2% or 0.3%, and then if you have, and then at the end of the year, I'm going to charge you another 0.1 or 0.2% for holding the money. So I'm not really a fan of mutual funds. They haven't really outperformed the market in the past decade, and a lot of them say they have, but you can go online. I'm going to show you Yahoo Finance at the end. You can go online and see all the mutual funds, what their holdings are, meaning where they invest their money, and see how they've outperformed or underperformed the market. So it's a way to, instead of you investing, giving your money to someone else to invest. Investment portfolio. Essentially, your portfolio of all the stocks and bonds, cash, gold, that you have in your own portfolio. Let's see. Ticker. Who knows what a ticker is?
Isn't that the thing that tells you what's going on in the stock market?
Okay, I see what you're saying. No, that's interesting. I've never heard anyone say that. So, no, a ticker is, like ticker for Apple, right, is AAPL. So when you go on Yahoo Finance and you want to learn about a company, you type in AAPL and Apple will show up. And Google is GOOG, and J&J is J, letter N, and then J. So those are the tickers. Dow Jones, who knows what Dow Jones is?
It's a stock market.
Right, so it's one of the 3 major indices of the stock market. So you have the Dow Jones, the NASDAQ, and then the S&P 500. The Dow Jones is widely cited in a lot of news reports because it's the industrial average of the 30 largest companies in America. These companies include Coca-Cola, they include GE. GE has the only company that's remained on the Dow Jones since its inception, which is pretty cool. J&J, and there's a few other companies that are on there. New York Stock Exchange, NYSE. Who knows what that is? It's a New York Stock Exchange. It's run all stocks are traded. It's in New York. That's basis point. Basis point is 1/100%. So say I'm a bond and I'm yielding 6.48%. I went up 2 basis points. How much am I yielding now? 6.5%. So it'd be 6.48 plus 2/100%. So 6.48 plus 0.02 would be 6.5. Wall Street, the financial realm where all the traders and all the investment bankers are, it's usually located in New York. There are large financial centers in Atlanta and Charlotte. London is the 2nd largest next to New York. So yeah, if you guys ever seen that movie Wall Street by Shia LaBeouf, he's in New York the whole time. Okay, so now we're going to look at your net worth. You know when you guys, sometimes you'll hear on the news, oh my net worth is $5 billion or 2 trillion or whatever, some obnoxious number. That's the grand total of your assets minus your liabilities, and essentially calculate all your assets minus all your liabilities to get your net worth. But let's kind of walk through it a little bit. Assets, so let's list the cost of your largest assets. If you guys have a house, you would calculate, I guess, the fair value of your house today. Your vehicle, the same way. Your liquid assets, so your savings accounts, your CDs, not like musical CDs, but like certificate of deposits you have at the bank. So you calculate all that gives you a number. Your liabilities, you do the same thing, but with all your debt you could say. So your home mortgage, your car loans, bank loans, all that. Liabilities, so credit cards, you guys have multiple credit cards, student loans outstanding, any other debt, calculate all that. Then you take your assets, minus your total liabilities, and you come to your net worth. Does that all make sense? Yeah? Okay. So trivia. What's the trivia today? How do you buy stocks? Dun dun dun. So, Kira, you want to buy 10 shares of J&J. How do you do that?
I would go to like one of the 3 stock exchanges and try to buy.
Yeah,
like
so, well, one way you could, maybe you can do that? I'm not sure. I don't know if you can knock on the door of the New York Stock Exchange and ask to buy shares of stock. I don't know how that would go over. But usually you go through a broker, directly or through a broker, right? So you guys know, I've heard of all the broker names. Oh, what happened here?
Oh, apologies.
Okay, net worth. Does everyone understand net worth?
Mm-hmm.
Sweet. Oh, never mind. We're going to talk about brokers in a minute. So debt to income ratio. This is a great ratio to know how much debt you have as a multiple of your income. So say your debt to income ratio was 2, it means you have twice as much debt than you have income, right? So how do you calculate this? You want your income to outweigh debt, but you are making more money that you owe. How do you know that is enough? Debt to income ratio helps with decisions such as what kind of bank loan to take out or to buy a house. So essentially kind of similar to what you did for summing up all your liabilities for that net worth calculation. Kind of do that for the debt side, for the debt to income ratio. So your mortgage payment, if you guys have a house or whatever, your car payment, credit cards, add that all up. And you can probably do this on a monthly or yearly basis. Monthly maybe would give you a quicker snapshot of your income today. And then your monthly income, so if you guys are on salary, if you guys are getting those year-end bonuses, your dividends, you guys are all excellent stock investors. You add that all up, that goes into your income. So debt over income is your debt to income ratio. Does this make sense? I see some kind of confused looks. Yeah? Okay. Please interrupt me.
I will.
That's right. We're talking about. That's income ratio. You want this number to be as low as possible, exactly. So less than 1, that's good. Creating investment portfolio. Did we even know about brokers? Okay, so you guys have some extra money, right? The best thing to do is when you're young is to put all your money in the stock market. Well, maybe not all of it, but a good majority of it. Because you're young, right? And you're investing in yourself in college. You're building your human capital, right? So after you come out of college, you guys are all supposedly going to have jobs, and you're going to have a lot of paychecks. So any losses you have today can be made up in the future, because you guys have long lives to live, right? So it's okay to be a little risky. You don't know the answers. You can throw some money in one company, see what happens. But before you just throw your money in the company, it's smart to do a little bit of research, right? Know what stocks to buy directly through your broker, maintain detailed records of your stock trades. Alright, so these are brokers. You guys heard of these names? They're pretty popular. Scottrade, E-Trade, Charles Schwab, Fidelity. Those are major brokers where you build an account, you go on fidelity.com, you create an account, you put some money in it, and you can trade stocks. You can just go on fidelity.com and be like, oh, I want to buy 10 shares of this company. Oh, I'm good, thank you. And so it's easy like that. And what's good about all these sites is they have their own like trading platform, if you will. So you can pull up charts, and if you like to look at charts, if that makes you happy, you can look up the history of the company, the most recent news that has come out, earnings reports, to see how the company is doing, and what management's doing, what are their goals for the near term and the long term. And this can help you decide whether or not you would like to buy shares in the company. And by shares, that's synonymous to me saying stocks. So what's the difference between all these, right? That's kind of important. So usually the difference is a trading platform, like how many charts you can show on one screen at once, what advice can you get from maybe professionals who work there, and the cost to trade. So say Apple's $100, right? You want to buy one share of Apple. Well, it costs more than $100 to buy a share of Apple, because you have to pay your broker to buy it for you. And usually brokerage costs are between like $7 and $15. So say you want to buy a share of Apple, it's really between $107 and $115 to buy. So you bought it, now you want to sell it. It's equally, you have to pay again to sell your share of stock. So it's going to be another $7 to $15 just to sell it. So keep that in mind when you guys open accounts and play with your own money. And if you guys don't want to play with your own money, there's actually fake brokerage accounts that'll give you like a fake $1 million, and you can put it in the real market to see how your money grows or it doesn't, and then you can, I guess, alter your strategy based on how well you did.
And all these companies do that?
What's that?
The fake...
No, these companies, these are real companies where you put your real money. So you could Google a fake brokerage investment portfolio, and you'll find hundreds of sites.
Oh, okay.
Yeah.
For the price that you have to pay the broker, that's not per stock, like $7 per stock. So like if you wanted to buy a share of Apple, one share, you would have to pay $7 or $15. What if you wanted to buy like 100 shares?
It's
flat $7 or $15?
It's per transaction, I should have said
Okay.
that. So say you want to buy 100 shares, it'd still be $7 to $15 to buy 100 shares. Yeah.
What's this transaction like?
It's a brokerage fee.
What constitutes a transaction exactly?
So when you want to buy or sell X number of shares of a company.
Okay, so if let's say you want to buy two stocks at one time, that's $7 to $15, and then another time you want to buy another 50. That's actually would it be better if you just want to
buy them all at once.
Okay.
That would save you the most money from a cost point, but that might not be the best move in terms of what the market's doing.
Okay.
But yeah, you're right. So I have a Scottrade account. Scottrade, $7. It's the cheapest that I found. So if you guys are looking to brokerage accounts, Scottrade is cheaper. Yeah.
How would you? Is that why you chose Scottrade? Is that the only reason because it was the cheapest? Is one better at getting you the smartest investment? One helping you better? Like, is one of these companies better, or is it just best to go with the cheapest one you can find?
Okay, so I am, I guess, really cost conscious. So I went with the cheapest one. My dad has E-Trade, and E-Trade is, I think, $10 to trade. But E-Trade has some pretty cool tools on it as to show you like the riskiness of a stock, and they assess it against its historical performance, which is pretty cool. So you can look at those as well. There's a lot of independent trading platforms where you can just buy through Scottrade, but then you have your own independent platform that charts and does all this analysis for you. E-Trade kind of combines that all in one, which is kind of nice. So there are little, I guess, bells and whistles to each one. But Scottrade sold me on their cheap cost to do a transaction.
Okay.
Yeah.
And is the E-Trade bells and whistles, is it really, would it make that much of a difference in your trading decisions and your, like, I guess your transactions or stance in the market? I mean, is it?
No, that's a good question. So in my opinion, there's two ways to look at any type of company, guys. Technically and fundamentally. Technically, it's actually looking at charts and drawing out what the company has done. And E-Trade does a great job at doing that. And that's really looking at the overall concept that history is going to predict the future. And history doesn't, but it does tell a tale at the same time. Now, fundamentally is looking at, you guys familiar with like financial statements, like the balance sheet, you guys have heard of this, an income statement, a cash flow statement. Fundamentally, you can look at those and see what the company's doing, where the company's spending money. I look at a company fundamentally. I think that's kind of the natural way to look at things. But technically, it lets you know when you want to get into the market. So you can go on E-Trade, read the chart, and okay, it's a good time to get into the market based on volume or all these other indicators. And that will let you know when to get in. And it can make a difference. Sometimes people think it does, sometimes people think it doesn't. There isn't a finite answer to that. It's all on who you ask. It's a very subjective answer to that question.
Okay.
Yeah. What's up, Patrice?
Is there a minimum that you need to open these accounts?
Yes, so there is a minimum. So when you open an account, I think you need to have a minimum of $500 in there to start an account. I could be wrong, don't quote me on that. But yeah, a lot of them like to see that you have assets readily available. So if you want to trade stocks and you start losing, that you're going to be able to, you have the collateral to keep being a long-term customer. They don't want you to buy, let's say Apple's $100 and you put $500 in your account, right? You buy 5 shares and then Apple goes to 0. And so you have no money in your account, and you're pretty much a wasted customer on their part. I think the minimum is $500. I don't think you can go below that, but it might be $500. It might be like $2 grand. I'm not really sure on the exact price, and it differs from broker to broker as well. It's all on what the broker wants.
So if you don't have one of these accounts, you just go to like the NYSE and just.
So I don't know how to. What the slide said was you can trade directly or through a broker. I don't know how to trade directly, so I think you could, maybe. The typical way for a common investor like ourselves is to go through a broker and buy shares.
Okay.
Yeah.
I think directly means like directly through the company. That's what I would think.
Oh, okay, yeah, so if you work for the company, right, like Publix, if you work for Publix, they award you shares of stock just for working there. You don't have to purchase anything. So usually if you work for a company, they will award you shares of stock in that way. If you want to purchase a large subset of stocks in different companies, the only way I know of is to go through a broker.
Okay.
Yep. Good question. Okay, so that's kind of pretty much all I was planning on covering. I'm going to go on the Yahoo Finance website, show an appreciation or depreciation of the yield. It's just part of the vocabulary that you hear a lot in finance. So say I'm the U.S. Treasury, right? And I'm yielding 2%, right? 2%. Right? Well, you find out that prices dropped the next day, right? So when prices drop, what happens to the yield, guys? Exactly, it goes up. So they're inversely related. So it goes up, and you find out it goes up by 0.02%, right? So 0.02% is 2 basis points. So a basis point is 0.01. That's a basis point. So when you hear someone say, oh man, I lost 50 basis points today. Well, they lost 0.5% on whatever they invested in. Like 100 basis points is 1%. It's just a way, instead of saying 0.01%, you can just say basis point.
Okay.
It's just part of the vocabulary that you hear in finance.
Okay.
Does that make sense? Yeah. Okay.
So do they call them points? Because I've never heard basis point before. Do they just say point?
Yeah, it's
Do
kind
they shorten
of,
it as point?
it's kind of just a finance type thing. You won't hear it very often outside of that industry. But yeah, I mean, you could say, well, if you say point, I think that's kind of arbitrary. A point can mean a lot of things. But to be more specific, if you said a basis point, I think more people would know if you would understand. Yeah. Any other questions? Anything specific you guys want to know about? No, maybe.
I guess I think I just want to know, when is a good, like when do you think is a good time to buy or sell? What trends do you look at specifically?
Okay, so kind of my experience, and yeah. So I've lost a lot of money in the market, but I've also won some, so I'm kind of like, I kind of broke even. It sucks to lose money. So major trends that I look at right now is macroeconomic policy, right? So are you guys familiar with the Fed, the New York Federal Reserve? You guys know what they do?
Make money.
Okay, well, yeah, that's bad that you know that that's what they do, but that is what they do. So they control the monetary policy of the United States, meaning they control how much cash is in the United States, right? So essentially all they do is print money. That's their only tool they can do to stabilize the economy. So they print a lot of money. And usually that money just trickles down to the stock market and it inflates the stock market, right? So the stock market right now is at 5-year highs for no reason other than the Federal Reserve printing money. Now I want to keep in mind these are my views, guys. These are my personal views. Don't take them as 100% truth. It's just what I look at in the market and what I see. But yeah, so the market's at 5-year highs right now due to, in my opinion, the Federal Reserve printing a lot of money. So I'm kind of weary right now as to get into the market because I think the market's going to have a huge retracement. And by retracement, I mean I feel like the market's going to stabilize back to some lower value that really determines the price of what the market's trading at. So macroeconomic trends. What's going on in Europe? You know, they're pretty banked up right now financially. What's going on in the United States? We're not too hot either, but we kind of cover it up a little bit better. What's going on in China? You know, they're one of the, you guys are familiar with the BRIC nations, Brazil, Russia, India, China? What's going on in China? You know, they've had this huge growth. What's going on in Japan? They just replaced their, the Bank of Japan minister or head 6 times over like the past 4 to 6 months. It's not a good sign when no one knows what to do with the head of the Bank of Japan. So stuff like that gets me interested as to where to invest. Because I look at what country to invest in, and then from there I go down to the industry, and then from there I pick some stocks. But good stocks to always go with, in my opinion, are stocks that you know. Stocks that are very familiar to you. Like you wouldn't want to invest in some, well maybe you would, but I would. Some company that makes these microprocessor chips that you don't even know what they do. They go into some surgical tool that doctors might use in some remote area. That's something that you don't probably know a lot about, so maybe you wouldn't want to put your money there. At the same time, maybe you do the research. Maybe you think it's a great new product that's going to revitalize that market. But companies that I like, the big companies, you know, they're going to pay a nice dividend, and dividends are always great, right? Dividends on major companies are between 3% and 5%. And that's more than your savings account, right? That's more than your treasury that you can get for 10 years. And this is just passive income that you're collecting. I keep picking J&J. I worked there over this past summer, so I'm kind of biased. But their dividend is 3.2% right now. This company, when I was there over summer, was at $65 a share. So if I would have bought a few shares, I would have been not too bad off, you know? Those are household names. that I think are always good companies to go with. They're the ones you know. What's up, man?
So when you say the dividend is 3.2%, you get 3.2% of the total profits they make. What is it? 3.2% of what from the company?
3.2% of the stock price. Or
So
no,
Times the
3.2.
amount of stocks you have.
Yeah, so you get 3% of that company's earnings
okay,
per year.
okay,
I believe they pay semi-annually, so you get 1.6% every 6 months.
okay.
Yeah.
So that's when they pay out every 6 months. Is you get
Let me check for you. I don't know if it's every 6 months or every year. So they pay every quarter, or every, oh, yep, they pay every quarter. So look in 2011, they paid a 57-cent dividend 4 times. So you get one every 3 months. You get 57 cents per share. You.
so 57 cents per share you own, and then
That comes out to be about 3.2% right now.
So as the stock prices go up, your dividend could go up.
Yep.
And
So
the same thing if they go down.
exactly. So a dividend is based on how profitable the company is, right? So what's good about J&J is they've raised their dividend every year for the past 50 years, which is really nice, right? So that shows that they're very profitable. But at the same time, that means they're making so much cash, they don't know what to do with it all. So they're giving it out to the shareholders, so the people who own stock in the company. But it's always nice to get a little reward to the side. But what people usually do with their dividend, so they get this dividend check of X amount of dollars, they usually just reinvest it in the company. That way it will grow your shares, and it will also potentially grow the dividend the next time. So you're reinvesting what you're earning. That all makes sense? Yeah?
so you get 57 cents. You say quarterly.
Well, now it's 61 cents, but yeah, as of February 2012, you get 57 cents, but yeah.
So if you bought one share, you get 57 cents quarterly.
Yep.
And then in order to even get those 57 cents, you have to pay $76 in example of
Correct.
J&J.
Correct.
Okay.
And then if the stock price goes up, I mean, you're getting that capital gains plus that dividend. But if the stock price goes down, you're still getting that dividend. But you made a loss on the actual stock.
So you could just hold on to it in hopes that it would go back up again and sell it when it goes back up again.
Of course. Yeah.
So sorry, I'm a little confused.
Okay.
When you buy a stock, you pay $76, right?
Yes.
So do you get the $76 back plus 57 cents? Or
No, you're thinking of a stock like a bond.
Oh.
No, so you get every quarter, so every 3 months, you get a check for 57 cents before taxes.
Okay.
And then you get that every 4 months.
Okay.
For as long as you own the stock, forever. You can own the stock till you're 100 years old, and you get 57 cents, or they increase it every year, but for our purposes, you get 57 cents every quarter for the rest of your life. Also, if they, for some reason, decided to cut their dividend, which they haven't in the last 50 years, so I don't know if they're going to, but there's always a possibility. Kira, what's up?
Whether a company pays out quarterly, semi-annually, or like annually just depends on the company, right?
Yep. So it's typical for companies to pay out semi-annually. Quarterly is nice. There's some companies that pay out monthly, which is even nicer. You get a check every month. But typically, because it's cost companies to go through all the dividends for all the shareholders, and they have a group of people that do this. So it costs companies to do it very frequently. That's why they do it like 2 times a year.
So Dustin, I think I understand what you're trying to ask you. You want to know what happens to that money that you invested in?
Mm-hmm.
You see that money after you sell it.
Mm-hmm.
That's once you sell it, that's when you see your return.
Oh, okay.
Yeah, so like say you bought a share from me, I'm J&J, you bought one for 76 bucks. Essentially give you a nice email that says you are now a shareholder of J&J, you own this many shares of stock. That's all you get, you don't get anything else. And then you get a dividend that comes along with that every quarter.
Okay.
And if you choose to sell, you reply back and be like, oh, that was a nice email with that piece of paper on it, but I want to sell this piece of paper and get my money back.
Okay.
And you do that.
Okay, so you get like say $76 plus however long you've had, multiplied by the 61 cents dividend forever.
Well, the dividend you get no matter when, like you don't get all your accumulated. Are you saying you get all your accumulated
Yeah, once you
dividends?
cash out, you've been a shareholder for a year.
Yeah.
And then you want to cash out, so you can multiply the 61 cents for the year, and then you add that to whatever you actually fully invested, as long as you didn't lose any money.
No, you buy the stock for $100 or whatever.
Okay.
And then for as long as you have it, you get a portion of the profits, which is the dividend or the 57 cents. And then the stock can go up or down, and you sell it. And let's say the stock went up, you sell for $200, you made $100 after you sell it.
Okay.
Does that make sense?
Yeah, so, okay.
Does that make sense?
And then it doesn't matter, with the dividends, it doesn't, when you sell it, you get to keep the dividends no matter what.
Yeah, that's your cash, man.
Okay, so,
It's like a paycheck.
It's
For as long as you have the
Alright.
stock until you sell.
okay,
It's a thank you. You're
Got it.
essentially owning the company, we're gonna write you a check.
great, okay.
It's nice. It's passive income, easy to make. What's your guys' favorite company?
Coca-Cola.
Alright. I think it's just K. So Coca-Cola, right. So they're currently trading at $37, right? We're up 0.6%, that's nice. And if you guys have an iPhone, the stock app, it's just the one that comes on your iPhone, it's the blue app. You can scroll on the bottom and see all the recent news, and I think that's what really moves the market. People try to find news before anyone else can, and that's what can move the market. So I'll look at maybe the top 3 or 4 of these, read through them, see what Coke's been up to. And then I'll look at its yield. This is a huge factor for me whether I'm going to buy or sell. Because why would I buy this company if I can get a lower or higher yield with the U.S. Treasury? You know, if I can get more than 2% anywhere, then I'm gonna buy Coke, and Coke's giving you 2.7%, so it's better, right? Everyone likes more money, unless you're the Capital One baby that doesn't like money. Okay, so I look at that. I don't want to get too financy. So I brought up this other chart that showed historical prices. This is really cool. You can see how it's traded over any period of time. I usually look at the dividends, right? See how they've increased their dividends slowly, but surely, all the way through 2012. You know, that's nice to know. They're a very profitable company. They're still paying their shareholders off. That's always nice to see. And then what's really good to look at, if you guys are really interested in like buying stocks into the future, I really suggest you guys start understanding financial statements. They're a little complicated, a little dry, a little boring, but you can understand what like capital expenditures, just to throw out a line item. That's essentially the company going out and buying huge buildings or investing in their company in such a way that can bring profits later down the line. So if a company has 0 capital expenditures, it means they're not growing or not spending money the right way. And why would you want to, buy a share of stock in that company if they're not investing their profits in a very profitable manner, right? It just makes logical sense. And there's several other things to look at. To see how much cash they have on hand. What if they're cash dry? They have no cash. Means they probably can't pay a dividend. Means they probably can't afford maybe some of the debt they took on. Maybe they have a lot of debt because they want to get started up really quickly. They're a smaller company. They go to the bank and get a huge loan. They're having trouble paying off the interest on that loan because they don't have any cash because they're blowing it all.
So is that when you want to get a bond from the company? If they have a
Exactly. Well, maybe you do. Because so what happens when I'm a failing company, right? Let's say that. I'm a failing company, and I'm running out of cash. I'm running out of all my resources. You buy a bond with me, you're probably going to get a 10 to 15% yield, which is pretty high for one bond. Because I'm a very, very risky company. And for you to put your money in me, is the market's telling you you're not the brightest investor. Because I'm giving you a huge yield. And if I fail, then you may get all of your money or you might receive a haircut. So say you gave me $100, I can't pay you that $100 back. I just failed. I'm broke, man. Like, I can't pay you $100, but I can pay you 50. I can give you $50, and if you held me for a year, I can give you 15% on that $50. So you may walk away with more, you may walk away with less. I suggest you don't invest in failing companies. It's not, it just makes sense not to do so. But yeah, no, that's a good point. Like, So U.S. Treasuries are sovereign debt, right? Sovereign debt is debt of countries, and Italy, you know, Europe's not doing too hot right now. But at one time, Italy and Spain's, I think 10-year was like at 50%. Meaning that that's really high yield. That's very risky because the market thought they were going to fail. Like the country itself was just going to collapse financially. There's not going to be any more. It was going to be dead, essentially. And that's crazy, right? Okay, so looking at this, and all right, so remember we were talking about the brokerage accounts and all the bells and whistles? Well, you can look at all the bells and whistles here too. I'm not going to get into this kind of stuff because this is like for a whole other class. But here you can do so much stuff with the chart to see what happened historically, project out which thing's going to happen in the future based on what happened historically. Sometimes you're right, sometimes you're wrong. Just a flip of the coin, essentially, what it comes down to. And see, there's a lot of acronyms here that are just crazy belligerent. Don't mean much, but you can overlap so much stuff on here. Like, what does all that mean, really? Is that all going to mean the stock price is going to go up? Yes, no. It's all about how much you want to study and get into this. I say you guys should just look at the news of the company. It makes the most sense. You understand what's going on with the company. And as of now, as like beginning investors, I think it's the right direction to take. Competitors, so Coca-Cola. Who's Coca-Cola's competitors, right? I don't even know. Pepsi's one. Ooh. Nestle apparently is one. Dr. Pepper Snapple Group is apparently one. And this gives you kind of a snapshot of all of their competitors and some of their financial metrics, so you can compare across all the competitors which one may be a better investment in the long run. What other questions you guys have? I don't have much for you guys. I can keep diving into this stuff, but I don't want to get too financy or bore you at the same time.
So looking at the competitors, if Coca-Cola has a competitor that's doing well, would you say that you should just automatically go for the competitor that's doing better, or would you rather go with the company that you know, like Coca-Cola, and then just trust that it will be nice and steady?
Yeah, Coca-Cola has a huge history, man. They're an international company, growing. I would probably go with Coca-Cola, no matter what you could tell me about their competitors, just because I know that brand resonates with me. So I'd probably go with Coke. But if like Dr. Pepper's in the news, it came out with Dr. Pepper 10, it's only for men, right? Or it's not for women, or something like that. That's a cool new like rebranding technique, and maybe that really like resonates with customers, and maybe customers are buying it off the shelves. I would take notice of that, and that might be in the news, and that might convince me to, well, I'm going to buy Coke, but Dr. Pepper's been doing pretty well with this new Dr. Pepper 10 product. Maybe I might buy a few series of Dr. Pepper.
Okay, so let's say you get a news release, Apple's about to release a new product.
Okay, new iPhone 7.
And then, so should you go ahead and go for it before they even release it? So you can jump in, right?
Yeah, so that's a great question. So if you can find out that Apple's going to release that before the public knows, that's when you should get in. Okay. Because typically the market is very efficient, meaning that it prices in all of this news as it's happening. Because you have these huge guys on Wall Street, right? That's in New York, all the banks and stuff, all the bank guys, that are constantly going through news reports in every country of the world. That's their job, to make sure they know what's happening about that company. And they buy and sell based on those news. So they're probably more inclined to get to that news faster than we can, because we just have like Yahoo Finance and stuff, and they have all this advanced technology.
Who were these people that know before everybody else?
There's a lot. What's that?
Professional banking people.
Yeah, they just have the resources out the yin yang to find information out before we can. And but yeah, so that's what I did. I bought Apple before the 4S came out, and it went up. It went up substantially because the market likes Apple, you know, and Apple's going to continue to go up every time they release a really good product, right? The 4S wasn't, too great of an improvement over the 4, so it went up a little bit. The 5, not too much on the 4S, but maybe their iPhone 6 will really knock it out of the park and be so revolutionary that the stock price might go up.
Were they negatively affected when Steve Jobs died?
You're right, they did. So why? Why did it get negatively affected? Just trying to spur a conversation. I don't know how much time we have, but I'm pretty much done.
About 5 minutes.
5 minutes, okay.
Spur uncertainty in the company?
So Steve Jobs was the innovator of Apple, right? So when he died, they thought, oh wow, we're not gonna have any more ideas because this guy rocked the company. These iPads and iPhones were awesome, and now this new guy, Tim Cook, who was this guy? He's no one. He's not the innovator that Steve Jobs was. And a lot of that uncertainty was priced into the market. And so when Steve Jobs did die, Apple did drop about 1% to 2%. So yeah, a lot of those factors take into place in the pricing of the stock. Good question?
Yes, I do.
Oh, okay.
So for financial statements,
Yeah.
an annual report would be.
Annual report is great.
Yeah, I actually have to design an annual report for a class right now, and I was wondering.
That is not fun.
What? Well, actually, I'm pretty excited about it.
Okay, cool.
But what? I mean, as someone who has probably seen quite a few annual reports, what advice would you give me designing an annual report so I could communicate best to people or?
Yeah. So have you seen a few annual reports, or do you know where to go to look at them?
Yeah, I've seen quite a few.
Yeah. Okay. So they're very extensive. Do they really want a complete annual report?
Not complete. We have to design 36 pages though. So.
Wow. What class is this? Just out of curiosity.
I don't even know the name, but it's I'm in graphic design, and a lot of the classes have kind of funny names like Style.
Yeah.
So it might be, I don't know exactly what it is.
So a lot of the annual reports.
It's my last year. I don't know.
So annual reports are a great other news source, right? I look at annual reports when I look at a company. It shows everything that company has done over that past year and their future outlook, which is a good snapshot of everything. But like I said, they're really extensive. It can be 50 to 100, sometimes 200 pages long. My advice to you would to be as concise as possible because that doesn't happen in these. Yeah. There's always footnotes on everything, and as a shareholder, I don't want to read footnotes. Tell me blatantly what's going on with the company. Is it growing? Is it not growing? Why and why not? The financial statements are important. I don't know if you'd have to include those, but if you did, let's go at the very end. Tell the story of the company of that year, and be direct. Thanks, guys, for having me. I really appreciate it.
Thank you so much, Justin.
Yeah.